What's up everyone? Thank you so much for tuning in, and if you're new, welcome to my channel. My name is Preeti Rao and I am both a real estate and a mortgage broker for close to 20 years. Now, did you guys recently read the article that came out on March 3rd by the Toronto Star? Canada's biggest bank set aside $2.5 billion to cover an expected wave of loan defaults. That was the title of the article. I got it as a WhatsApp forward from a client who read the article and then decided not to buy, but to wait. Because what he understood from that article was that we are all doomed. The market is going to crash. There's going to be lots of power of sale houses everywhere for him to just pick for free. Doesn't work like that. Now, I'm going to cover this topic on power of sale homes soon. But today, I want to discuss this particular article and how it has landed up unknowingly sending out misleading information. But first, you know the drill. Make sure to like, share, subscribe, tap that bell icon. It gets me motivated to keep you up to date with everything real estate. So, the Toronto Star is reporting that Canadian banks have now put aside $2.5 billion in order to prepare for credit losses, including those coming from mortgages to some extent. And the article suggested that they're preparing for the upcoming wave of expected loan defaults. And this comes on the heel of the big banks reporting their 2022 profits, which includes the sharing of their most recent financial statements. And those financial statements, of course, include the increased buffers with respect to the provisions for future losses. But are the banks really preparing for a loss default apocalypse? Or is there something else in the story? Well, there is. See, just like showbiz, the trailer is made to entice you to go and watch a movie, or clips of what's to come next week keeps you hooked on to that show. That's exactly what the tagline of this article did. The way this was portrayed made it sound like the banks are expecting catastrophe. They are hoarding money to protect themselves for this event. But guys, that's not 100% true. Yes, Canada's biggest banks have set aside $2.5 billion to cover an unexpected wave of loan defaults. But the banks say their credit losses will return to pre-pandemic levels as borrowers face higher interest costs and expenses on credit cards, car loans, and line of credits. Borrowers are expected to be hit the hardest. This would lead us to believe that the banks are preparing for a massive default and that the banks are acting prudently so that when the worst happens, which they are expecting to happen, they're prepared. So they're protecting themselves, right? That's the implication of this article. That is what is written to make you believe. But they're missing out some key points here, because this isn't what's really going on. Bank executives have recently said this week that they don't expect a dramatic spike in defaults, particularly as employment remains high, but they anticipate what they call as normalization of a credit loss trend. So even though the banks are putting away a massive amount of money, they don't expect there's going to be a hike in default. So if they don't expect that there's going to be a hike in default, why are they putting money away? This doesn't make sense, right? See, the thing is, in the last quarter of 2019, banks had already put away $2.5 billion pre-pandemic because some defaults were starting to increase. And also, they were instructed in 2018 by OSFI, who is the Office of the Superintendent of Financial Institutions. They created a new rule that required the banks to carry a buffer in case of higher delinquencies. And keep in mind, this was done pre-pandemic. And it was also done in order to create some security around the Canadian banking system, even though there was nothing to suggest at that time that these things were needed to be done in order to make sure that our banking system was bulletproof. This topic was actually covered in an article on Jan 8th of 2020. OSFI had created rules around creating buffers in order to protect our Canadian banking system from things that could happen outside of our country and affect us internally. And at that time, they were increasing their allowance for delinquencies up to $2.5 billion. And this was again in the fourth quarter of 2019. Pre-pandemic. So now as we come out of the pandemic and as interest rates get higher and things seem to be a little bit more scary with respect to the amount of payments that people have to make, well, now it seems prudent that the banks increase their reserves against those pre-pandemic levels. Note this isn't because the banks are doing this out of their own accord. The reason why they've put this money aside is because they were instructed to do so by OSFI, and their deadline date was the end of Feb of 2023. So this is actually old news that was presented as something happening today because of a possible shift that might happen tomorrow. This isn't an indicator that the delinquencies are up. This isn't an indicator that our banks are expecting everybody not to be able to pay their mortgage. This is simply a result of what happened last year. So if you have any questions or want clarifications, please don't hesitate to call me. If you still don't know who I am, just go check out my Google rating and read my client reviews. Till then, take care. If you found value and liked this video and would like to see more content, click on the boxes on the screen. Once again, my name is Preeti Rao. My contact information is in the description box below. Make sure to hit like, share, subscribe and the bell icon so you don't miss any future videos. Thank you so much for watching, and don't forget to call me because I hold the key that opens the door to your dream home.